Hey folks, Stanford here, the rate update. Today is June 29th, 2021. What we're going to talk about today is the Case-Shiller Index came in and said house prices are smoking. Should we be concerned? Well, we're going to go over that. And also we're going to do some number comparisons. If mortgage rates go up to 6%, what would that do to your mortgage payment? So don't go away. We're going to talk about those things next. Hey folks, today we had Case-Shiller Index came out. What that is it tells us how housing is doing, how much houses are appreciating over time. And it was a great number for homeowners. For those that aren't homeowners, I might have some good news for you there as well. Okay, so today we want to tackle two things. We want to tackle, home prices are up 14% year over year, the hottest number ever since they've been recording things. And I want to show you my thoughts on that. And then I'm also going to show you what would happen to your mortgage payment if rates went from 3% to 4 to 5. Would you not be able to buy a house if rates hit 5%? So I'm going to go over those numbers with you here in a second. So let's first off, we're going to talk about what's house prices or house appreciation is doing. So CoreLogic, Case-Shiller soared to its highest growth rate since the index began. So basically what this is saying is the national home prices grew at a 14.6% growth rate, beats the previous housing boom. And you're going to say, some are applauding, and some of you guys are saying, see, I told you, Dan, there's this huge bubble that's taking place, and that it's going to explode. Well, let's dissect a few different areas. Okay, so this is the Case-Shiller Index from basically 2013 all the way up to now. All right, so we have house appreciation through all that time up into like 2014 was really good. It was averaged between 8 and 14%. Then all of a sudden it subsided, but it was still averaging, let's say, on average 6%. So you average 6% from 2014 to about 2018. Okay, 6% a year for 4 years. All right, remember that number. Then all of a sudden back in 19, we were sitting at about a 2% appreciation. So in 19 and 20, 2019 and 2020, we saw approximately about a 2%, 3% appreciation per year. So over those 2 years, let's say we picked up 6%. All right. So in 2 years, we picked up 6%. Over here, if you take a 2-year analysis between here, you would have picked up about 12%. Okay, so it's a 6% differential there than normal. Okay? So if this was normal, you would be basically treading water right here. Remember, take that line across. So it wouldn't seem as substantial. All right? So what you have to remember is for 2 years or about a year and a half, the whole country just shut down. So let me explain it in economic terms. Let's say, for example, I'm the manufacturer of a widget. And this widget has to be bought by everybody producing cars. Okay? So we have this widget that needs to go in every car. And normally people will pay $1 for it. And we sell millions of them. All of a sudden we had a shortage. And now I'm only able to produce maybe 1/4 of what I normally produce. Well, all these car dealerships, they're like, well, I need that product to build a car. So they want to buy. Well, on my side, I'm a shrewd businessman and I know how economics works. There's supply and demand. So I increase my price of that widget up to the point where I hit an equilibrium. I have enough product to supply the suppliers willing to pay that particular price. Okay, so that's that part of it. All right, what you're seeing right now is a very limited supply of homes on the market. That's one big component of this housing boom, as well as interest rates. Yes, interest rates are the lowest they've ever been in history, but you also have a shortage of homes on the market. You have that supply-demand chart. Okay, so here's another reason behind this. You have a lot of people in forbearances. There's over 2 million forbearances out there. What a forbearance is that person isn't making their mortgage payment right now. So if you're not making a mortgage payment right now and you own a house, Would you sell it and then have to rent or buy another house? No, you'd ride out the forbearance. So in September of this year, you're going to have forbearances stop, and you're going to have student loan deferrals stop, and you're going to have excess employment benefits stop. So come October, people are going to start to freak. Okay, so if you're in a forbearance, I highly suggest you call us to get an exit strategy, because I don't want to see you getting a $20,000 mortgage statement and saying, oh boy, now what am I going to do? So that's what's happening in that front. Okay, so what my thought is, and I hope this pans out, and it's the most logical that I can think of, is everybody's going to freak out come September, October, November, but the dust will eventually settle. Okay, when the dust settles, we'll come back to that equilibrium. Now people have to make their mortgage payments. If they can't make their mortgage payments, they're most likely going to sell the house, downside, rent, or do whatever they have to. I don't see a lot of short sales coming in, and I don't see a lot of foreclosures, because there is, we all agree, there's been huge appreciation, maybe too much. But if you bought a house 2-3 years ago, you're riding this wave. So you shouldn't be upside down that you would have to short sell your home or get foreclosed on. You could sell it. So it goes into the market, and now you're having more and more and more houses come available, and that'll start, equilibrium, or bringing the home values back in line. Is there going to be a crash? No. Will there be possibly a subsiding of the values? Maybe. Or there might be nothing. We might have enough, it might get to an equilibrium on where we're at today. Okay, so only time's going to tell on that part. The second part of this equation we're going to talk about is mortgage rates. If mortgage rates, everybody's like, oh, it's going to get out of control. People will never be able to afford a home. Let's go through something. Okay, so what I did here is you can go to this website, and I'll post it down below. It's rentaldata.org. And what you do there is you go into it, and you can find, it says it gives you rents all over the country. So what I did is I found this, and for my purposes, I'm going to say, okay, we're going to go into Florida and see where this puts us. Okay, Florida, if you bought a studio or rented a studio apartment, that's what it would cost you right now. And if you bought rented a 4-bedroom place, it would cost you approximately this. Okay. The next thing I did is said, what are the average home prices in Florida? So I got a number of 226,600. So what I suggest you do is go to my website, and my website is therateupdate.com. Go over to free tools, go into payment calculator, and you're going to start plugging in some numbers. So we get that number, 226,600 is the purchase price. Average purchase price in Florida. We're going to go with the first-time homebuyer program, and you only need 3% down. So that if you put 3% down in this program, you'd have a $219,802 mortgage. We're going to say the rate is 3%. We're going to take that out, 30-year amortization. It actually monitors the PMI. The PMI factor I'm going to put is 0.85. That's the normal there. And we're going to leave everything else the same, whatever it defaults to. Okay? Then we're going to hit the calculator. And what would my payment be? Well, my payment would be $1,300. Okay? So let's go back to how much that we could have got if we rented something. $1,300. We could have got a 3-bedroom apartment for $1,300. Pretty sweet. So let's say, well, okay, I can do that because I'm paying more than that now. All right, wonder if rates went to 4. Okay, right now, let's write down this number. We got $1,300. It goes to 4. What's that payment going to be? $1,422. Went up $122. So if rates went all the way up to 4%, can you afford an extra $120? Maybe, maybe not. Well, let's say they just went out of control and they went to 5. What would that payment be? $1,552. So it went up $250 from 3 all the way to 5%. Would that cause you from buying a house? $250? Probably not. When you see all these ads and you hear all this data, you're like, my thought is it completely puts me out of realm of buying a house. We're talking, $500, $600, $700, $800 more. $1,552. It's still cheaper than what you would rent a 4-bedroom apartment So that's my talking about the housing appreciation and mortgage rates for today. So what did rates do today? Mortgage rates inched toward 2-week low, which is great news. Let's see what's happening live in the market. MBSs are up 6 points. What does up 6 points mean? Is that terrible because that's going up? No, and we know when the MBS prices go up, rates come down. So here's what's happening. Well, for those newbies, MBSs, what that means is mortgage-backed security. It's a bond that trades on Wall Street that is the biggest part or the biggest component of your mortgage rate, okay? This number right here represents what happened to the price of that bond for the day. Let me just give you some insight. As that price goes up, rates come down on your mortgage. Well, we had rates kind of on a nice little roll here, and then in May when the Federal Reserve met, it spooked the market and rates went up. This went down. Remember, prices down, rates up. Then what happened is Fed came out and all the news kind of subsided and we went back up to where we kind of were, and then we retrieved a little bit and then we stayed stagnant for a while. Then what happened? Well, the next month came and the Federal Reserve news came out and it shocked the market. Then from there I said, guys, just wait. So if your mortgage person locked you in here because they were freaking out, they did you a disservice, okay? What I said, feel free to go back to my videos. We're going to subside and we're going to come back to about this range here, and then we should stagnate from there. I was a little bit wrong because we've even done better. So what does that mean? Well, I thought rates were going to be higher than what they were, and we're waiting and waiting, and they keep getting better and better and better, okay? There's some cool things happening right now, though. You see these lines right here. These are what we call Fibonacci levels. These are technical levels. They aren't technically lines there. They're fictitious lines that create a ceiling and a floor when it comes to charting, okay? So what should happen is this number should bounce around in this area and stay in that area, okay? It's doing just that. Look, we've validated these numbers all through these areas right here, okay? So let me clean this up for you for a second. There's other areas that we focus on when we're charting, okay? And that's these areas here, the 200, 150, and 25, you see DMA, day moving averages. And those are lines right here, okay? Look at this line right here. Where did we hit? Okay, if you go back to my video the other day, I said where our next point should be, we should start to hit these levels. We just hit it right there and we stopped. So that validates that line right there, okay? So there was news out today, and I'm going to go through the economic news. We went to that number and stopped. The Federal Reserve came out with their numbers that washed out all this bad news. So right now, where I see us being in the next couple days or weeks, we should be stagnant right here. Or maybe we'll pick up a little bit of points, or we'll come down a little bit. But we should stay right in this realm here. So there should be no shocks to us with what happens with mortgage rates. So that's what's going on with mortgage rates in the long term. Now let's go see what happened today. We had a nice little upward move and then we started to stagnate. What I don't like is right here. We have 3 out of 4 of these are red candlesticks, meaning there's more sellers than buyers. So what I'm gonna predict right now through the end of the week and even Monday, maybe Tuesday, a lot of people are traders. Again, remember when I said that this is a bond that trades on Wall Street? Well, you're going to have Wall Street going on vacation for the long weekend coming up. So Friday is going to be, there's going to be very limited people working. Well, Friday, Thursday, and Friday, there's news coming out that would normally affect the markets, but there's not going to be a lot of people working. So those that do anything when it comes to these numbers are going to make it even more blown up. So what I mean by this is, if there's normally, let's say 100,000 buyers of mortgage-backed securities that day, and you only have 1,000, each trade is going to emphasize that direction. Meaning, if you have 1,000 sellers that day, then the market could come tumbling down. Okay, so I'm not going to do anything on Thursday and Friday because I think it'll be an overreaction one way or another, unless some of this data comes in really out of whack. What I mean by that is you have a lot of job numbers coming in, and unemployment rate, payroll. These are a lot of the numbers that the Federal Reserve watches. Okay. They already said that they're going to let this run a little bit hot until basically the end of the year or first quarter of next year, kind of saying what I'm saying about all the forbearances and everything. So I'm not going to do anything. So people that are asking me, hey, Dan, what are you going to do coming into the week? I'm not really going to do anything because there's really none of this should really catastrophically affect the markets in one way or another. And if you do see some major jumps, it's basically going to be because there's limited traders working that day. Okay. So where are rates today? This was updated just yesterday, so it hasn't taken effect with what happened today. But what this Black Knight does is they send out a survey to mortgage lenders all over the country. We respond, and here's the data. We publish 30-year. These are not my rates. These are national averages. So you got a 30-year conforming, jumbo, FHA, and VA. Here's the rates throughout the nation, okay? This over here, 1 day, 7 day, and 4 week delta means change. So this is how much they changed in a day, a week, and a month. It's virtually nothing. What a basis point is, like 4 basis points right here, that equates out to in numbers, 0.04. Okay, so nothing, nothing there. The trend is nice. It's nice and steady as we have anywhere else. So that's where we are with rates today. So hopefully I answered a lot of the questions that you guys have out there. So what I ask you to do is if you're building a house and you need a long-term lock, this is if you're using a builder, a major builder to build the house. And we can do your loan. A lot of them do their own financing, but the problem is they will only lock you on a 60-day term. We have in many states, we can lock you up to 1 year. So that's number one. If you're looking for a pre-approval, we'd love to help you. We can do it in probably about 15 minutes. You can do everything on your phone if you want to. If not, I'll give you ways to reach out to us and get a hold of us personally. And if you're looking to refinance, if your rate is 4 or higher, please call us. And if you're in a forbearance, you have to call. That's all I'm going to say. It's no high pressure sales. Basically, we're just going to consult you and give you all the options that you have available at your disposal to refinance. So how do you find out more about me and my team? Well, the first thing I'd like you to do is, if you would, you're watching my video, go to my channel. It's the Rate Update with Dan Frio. There's over 900 videos, and we just exceeded 14,000 subscribers. There's got to be something in there you like. And then the last but not least is our website, therateupdate.com. You can click here and start your mortgage application basically immediately. You can do it from your phone or your desktop. If you'd rather call us, scroll down and you'll find our 800 number, 844-775-LOAN. What most people are doing, because they're following us in the evenings and weekends and so forth, they scroll up a little bit and you're going to get this Calendarly post here. You can pick a 15, 30, or 60-minute consultation. You click it. You find the days and times available that I have. You open that up and it'll give you all the times available. You click that and you'll get an alert. I'll get an alert, and then I'll see you on that day at that time to answer any and all questions you got. So that's it for today, guys. Thanks so much for watching. God bless. I'll see you tomorrow. Bye-bye.